Hello guys, good afternoon. Today is Sunday, and I'm gonna be talking about a couple of subjects that have been um, asked about through the commentaries, or basically things that I've maybe not explained a couple of times, but still mentioned. And yeah, that's really pretty much it. And again, as I've mentioned a couple of times on the videos, if you ever have any kind of questions, just leave them on the commentary of the video, or you can talk to me through Instagram, Telegram, the mail. I do believe that YouTube allows you to get my mail to email me about stuff that you can use as well. But overall, Telegram or the commentaries is just gonna be pretty simple to get answered. And we've got a couple of subjects that I'm going to be going through, but we'll begin with the how or why I do things the way that I do, right? Because I've never really explained how I've got into the conclusion of why I do things the way that I do, right? As an example, why do I specifically wait for a run on buy side liquidity, run on sell side liquidity, and then wait for displacement in the 5-minute that causes a market shift and creates a fair value gap in the meantime, to then look for the lower time frames to mitigate that fair value gap from the 5 or the 15-minute to then basically try and sell. And talking about that, right, the way that I don't want to say created those steps, but I realized that those steps or those instructions were something that repeated themselves over the time in the market are by two things. First of all, of course, is by ICT's teachings, right? By ICT's teachings, I realized that a run on buy side liquidity or sell side liquidity and then displacement shows that either the algorithm or the market makers are just trying to, as an example, if a run on sell side has just happened and then if there's displacement that causes a market shift and creates a fair value gap, then that means that there's an opportunity for us to take, because the market is likely to take advantage of what it has just done. Yeah. So first of all, again, it's because of ICT. ICT teaches the concepts. He shows how to apply them in the market. He does it with indexes, but they work apparently exactly the same. Can't really say much about that because I only trade euro-dollar. Don't look at indices or anything like that. So that's first of all. And second of all, as an example, what I did in the past was, well, not in the past. Oh, actually, I think I messed up this. Hold on. Yeah, okay. I don't know why I didn't have that. And I don't even have the indicators. Well, in the meantime, I can show how it looked in my indicator. Sessions on chart. The most downloaded one usually is going to be the past, but I modify it with just London and New York. And New York is 7 to 10. Yeah, 7 to 10. And then London 2 to 5, right? Which are the kill zones, not the actual sessions per se, but the kill zones of them. So as an example, what I did in my time when I started not analyzing, but looking into ICT strategy, this is exactly what I did. I basically put on the charts the timings between 7 and 10 and looked at basically what happened. So as an example, if ICT says that when a high is taken as liquidity and then you see displacement, this fair value gap created here could be an opportunity for you to take a sell, right? Same thing when you have a low being taken, displacement that causes a market shift, right, and creates 5-minute fair value gap. As an example, 5-minute. He does apply this differently. As an example, he says that when a low is run, right, when a low is taken as liquidity, this is where you look for the entries, right? You go down to the 4-minute, the 3, the 2, and the 1, and the first one that causes that market shift and creates the fair value gap, the displacement along with the fair value gap, that's what you can take as an opportunity. I don't do that because as we have multiple lows, multiple highs, we could get many fake entries. And I do believe that the way that ICT teaches this exact thing, this exact method of execution, he does say like it's not taking every single low or every single high, is looking for a clear run on liquidity that happens in favor of the trend, or what we expect to be the daily trend or the weekly trend, to then look for this exact thing to happen, right? So again, it's not like this high was taken here, so that's my 1 minute entry, or this lows were taken, maybe I can find a buy in that, right? So I just wanted to explain that, because I'm not saying that I do it differently than ICT because it doesn't work. I'm saying that I do it differently because it's what by doing this, what I'm about to explain, that's what I realized worked the most, and the thing that I kind of do like executing or trading the most, right? So for me to get to the point where I currently am, where I realized that these three specific things, or 5 or 6 specific things occur, is by looking at the charts like this, just simply going to the 5 minute, looking at the sessions and seeing what repeats itself. As an example, I will talk about timings as well, or why I use phases between quotes, because this is actually a pretty clear example. And when I did my study on ICT, give me a second, I realized that there were things that repeated themselves through different times of the day, right? And what that led me to understand as an example is that here, that I've already shown this a couple of times. So as an example, phase 1, based on the timings from 7 to 8:30, we usually see price moving against the recent trend, running a buys or sells the liquidity, aggression in the expected direction that creates fair value gaps, and the creation of those fair value gaps are later used on phase 1. Phase 1 is from 8:30 to 9:30. And as an example, we can see price retracing into phase 1 fair value gaps, run against the trend, running a buy side liquidity, aggression creates fair value gaps. And as an example, if we looked at it from the way that ICT teaches this, we could apply this exact thing when I say run against the trend. This happens because of the power of 3. You know that ICT says that the power of 3 is distribution, manipulation, and distribution? No, sorry. Accumulation, manipulation, distribution. This is exactly it, because he says that, as an example, either midnight or 8:30 can be the point of open when you begin analyzing it as a power of 3. So if we look at it at this day's price action and go to 8:30, 8:30 is here. Well, actually, in this case, would have not worked out, right? But as you can see, phase 1 has the move against the trend and the run and sell side liquidity. Phase 2 doesn't trade inside for, well, actually, it begins inside of phase 1 fair value gap. I'm not zoomed in enough, I know, but you know, it begins the day or the session inside of phase 1 fair value gap. It's not the same, but it is, as I actually did start trading this when price began inside of phase 1 fair value gap. I started trading that, and it does work out approximately the same. But as you can see, it does follow the trend, causes breaks of structure just following that, and well, more fair value gaps are created in favor of the trend, right? So as an example, when I was doing this, basically just saying, okay, so this day price goes lower, takes us out, continues higher. What did this day do? So midnight went higher aggressively, took buy side liquidity, and then started moving lower. Phase 1, or well, 7 to 8:30, we kind of see this move against the trend, and then just a continuation of the trend that will then turns into this big complicated price action. There are days that, as an example, you might be looking at the days like this, and you say, okay, so in this day it didn't really work out entirely, right? Because we do have this move against the trend, and then price just continues with the trend, but then we have this. So is this something that doesn't work out exactly like that, or there are days that price does this? Why did this happen? As an example, now I do have a better understanding of why this happened, which I already talked about it on the week resume, because we had a lot of liquidity and everything, and it was just a retracement. But overall, this is exactly what I did. This is how I got, like, as an example, again, phase 1 tends to run against the trend, take sell side or buy side liquidity to then just continue with the trend set by London. We'll talk about bias in a minute, right? But what I'm trying to explain here is that by looking at price and understand what price has done, or why price, as an example, went lower and then higher, or basically just went lower for a bit, why did price go lower? And of course, again, it's not saying, okay, so what happens between 7 and 10? It's not just going with your head without understanding a single thing and trying to expect that when you look at what price does usually, then you'll be able to understand why certain things happen. It's not that I just watched the first, as an example, class of ICT and said, okay, yeah, this is exactly what happened. So let's look if that repeated itself, and then let's just try and take advantage of it. I watched the entire mentorship. I'm rewatching it now. And based on the concepts, based on the power of three, based on the run and stops, and then displacement higher or lower, that's when I started realizing that, okay, so that's a way that we can take advantage of. Let's see if we see it repeat on price. When you look into price, you say, okay, so here price did build some liquidity, and then there's a correction higher, displacement here, the price trades into, and then continues higher. As an example, there's liquidity here. Price takes that and starts going aggressively lower, and so on and so forth. So the way that I got to the point where I currently am, where I have series of things that tend to repeat themselves, and I'm able to understand that those things could indicate me that price could go higher or lower at a certain point, or even time in price, is because of this. I just went through each day and said, okay, so London this day went lower, higher, lower, higher. Just follow the trend. What did we have before that? Well, before midnight, we had a run on buy side liquidity, and then price just continued creating lower lows, lower highs, lower lows, lower highs. We then have somewhat of a range between pre-New York and stuff like that. So what will be somewhat of the process in the meantime, right? It'd be like this. So day one, London just created lower lows and lower highs. Midnight, they take BSL and started going lower. What did this day do through as an example, something that I did note when I was starting this, I realized that in some cases we have two things that repeat themselves kind of similarly. So as I said, phase one as an example tends to trade against the trend. It's like a little bit of a retracement that looks for liquidity, or basically just trades against the trend, which tends to manipulate people into believing that the trend might be completely the opposite of what it's actually going to be like, right? So as an example, phase one begins after a tiny retracement. This is something that I will mention. And then phase two causes a retracement and trades inside phase one for value gap. And phase two also takes BSL to then continue lower. As an example, this is what I could have about a day, right? That's something that I could have about a day. And then I could go to the next one, or the next one, or the previous one. And then I could say, okay, so day number two. What did midnight do? Midnight took and created some BSL. No, actually created BSL. Midnight created BSL. London took BSL and started going lower. Phase one continued with trend. Phase two traded against trend, took BSL, started going lower. And as an example, this is something that you could do and say, so these things are repeating themselves. This exact thing is what happens through every day, or not necessarily every day, of course. It's not like you can go and backtest and you will see every single day a high or a low being taken, and then immediately we're going to find an entry, right? That's not how it works. But creating a somewhat of a log like this, where you have, okay, so we have day one did exactly this, day two did exactly this. What is it that you're going to be able to see later on when you have a little bit more of background, or as an example, maybe 10 days, maybe 15 days, maybe 20 days, right? An entire month of price action. What you'll see is that, as an example, in this case, London was just going lower, right? Simply. But we do have that midnight did take buy side liquidity and started going lower. So basically here we have that liquidity was taken, and then just a trend was started, and through the entire day that was respected, right? What is it that we have here? Phase one begins after a tiny bit of a retracement and just continues with the trend, right? So based on that, what is it that we had? After midnight has taken buy side liquidity and continued lower, phase one did this, right? Maybe that's something that repeats itself over and over. Phase 2, we see a retracement there, and phase 2 traded against the trend. Both are a retracement. Then we have that phase 2 takes buy-side liquidity. Here took buy-side liquidity as well, and then continue lower, continue lower. This is exactly how I personally got to the point where I say this is something that repeats itself either not every single day, but repeats consistently based on the concepts taught by a pretty good trader, right? Pretty good trader, maybe I don't think the best trader in the world. We probably wouldn't know the best trader in the world. But basically a person that knows a lot of stuff, that knows how the market works. And he shows that every single day, right? So first of all, it's about understanding concepts taught by someone that knows those concepts. And then you just go into the charts and look for those things. Again, if you had 20 days where you wrote, okay, so here we have midnight took a little bit of liquidity, then London went lower, took sell side, and then started trading completely against that. What do we have here in phase 1? Doesn't really move much, goes higher. It does take buy side liquidity. Phase 1 does take buy side liquidity. Session begins here, doesn't really do much, to be fully honest, just creates continuation to the downside, creating some fair value gaps to trade. If I remember correctly, we had a fair value gap in the 15-minute on that one. What do we have on this one as an example? Midnight took buy side liquidity, kind of given the trend to be bearish. London trades a bit against the trend, continues lower. So you can see pre-New York begins after a tiny bit of a retracement, going against the trend, and then continues lower, takes sell side liquidity. Well, actually, session, as you can see, this is A30, session takes sell side liquidity and then goes completely in the opposite direction. And so on and so forth. Basically, you're going to have multiple days where you see things repeating themselves. As an example here, we have somewhat of the same as we just saw on this previous day that we just saw, which is a run of liquidity and then goes completely against that, right? So is this a move against the trend on phase 1? Not really, because at that point it was not a move against the trend. It's actually in favor of the trend, right? But it took enough sell side liquidity to just completely change the directions. How could have we taken advantage of a day like this? Well, it took a lot of sales of liquidity, and then you can see a change in the trend. Could we expect the price to maybe take buy side and then continue lower? Yeah. Do we have confluences, or does price give us something that we've seen or we understand based on what we know that could have indicated us to sell? In this case, no. Knowing what I know personally now, I'm not saying in the past, but now, we do have a lot of round of buy side liquidity, but there's no 5-minute displacement inside of the kill zone. So there's nothing that I can actually do about that. Right? That's the way that I got the knowledge that I currently have. Watching ICT's concepts or mentorship, understanding them, and then just going to the charts and look for them. It's not something that is going to take you an afternoon or a day or two. It's something that is going to take you weeks. If I remember correctly, I spent like 2 or 3 weeks just doing this, just saying, okay, so these are the kill zones. These are the times where I have to look at what price does. And that's when you start realizing that things are just repeating themselves over and over. That's how I got to the point where I said, so if I wait for this exactly to happen, I'm very confident that I could take profits on this one. I know that I can't be 100% sure, and at the same time, I probably could make a mistake. As an example, I understand that this is maybe a run of sales or buys of liquidity, and it's actually just following the trend and then goes completely against me. Definitely possible. We're going to take losses, whether we like it or not. It's part of the game, basically. But overall, I know that those things repeat themselves, so I know I can trust them, right? That's simply how I got to where I am. And what I do on my videos, on this videos like this, is just show how I personally understood ICT's concepts and how I like applying them based, again, on what I've backtested or what I have understood over the time, over the weeks, right? This is not something that I did one day to the other, right? It's something that took me a couple of weeks with, first of all, of course. So first I watched the ICT mentorship, and then this couple of weeks where I realized that, as an example, things like the ones that I taught are things that repeat themselves over and over, right? That's pretty much it, right? That's pretty much it about phase 1, let's call it, of the video. We're going to jump onto why I use phases, which I kind of already explained. So for me, it's because of the way that I back tested this, which is this way, right? Just looking at the kill zones and saying, okay, so this is repeating. See how price does this tiny bit of a move, takes buy side, and then goes lower. So this is phase one. This is, let's forget about phase one and phase two or phase three for now. This is price trading against the trend as soon as kill zone begins, taking buy side and then going lower. Is this respected? No, but let's just keep our heads into this right now. This exact thing, price just going against the trend, or what we are expecting to be the trend, or the London trend, is something that repeats itself over and over. Maybe if we go to the next day, see how it trades against the trend, takes buy side, and just continues with the trend. Let's see on this one, price is going higher. Look at phase one, begins, starts trend lower. Again, I call it phase one now, but in the moment I didn't call it phase one. I just saw price as soon as the kill zone begun going against the trend, and in some cases taking sell side or buy side liquidity. The reason why I call them phases is because it was easier for me to say, instead of saying from 7 to 8:30, I just call it phase one. In phase one, we see this exact couple of things repeating themselves, right? Which is what I just saw. Phase one tends to move against a trend, run on buy side, then aggression in the expected direction. That creates fair value gaps, and those fair value gaps are later used through phase two. I'm not saying that all of this happens together. I'm not saying that all of this happen every single day, but I'm saying that from backtesting, I realized that this is something that works out. This is something that happens repeatedly, which allows me to understand what could the trend or the bias be for the day. We're going to talk about bias later. Not going to include it now. So that's why I call it phases. It's because it's easier for me to understand it that way. I know that through 7 and 8:30, between 7 and 8:30, we can see this happening, which allows me to maybe take advantage of price and try and trade, or just try and understand what could happen through the rest of the day. Could give me direction, because as an example, if I know that phase one moves against the trend and tends to take sell side or buy side liquidity, right? What happens through this phase one? Phase one begins, goes a bit higher, goes against the trend, right? Why against the trend? Because London was bullish. Phase one begins and it starts trading lower. And what do we have here? Sell side. So we have two things. Do we have aggression later that creates fair value gaps? Yeah. We even have a market shift. And at that time, I didn't really wait for that, right? At that time, as an example, it's something I actually didn't wait for. Never really found much of an issue, but then I realized that it's just a little bit of an extra confluence that tends to be better to have, right? And then we have that. That could have been an entry to take, as an example, just based on the 5 minute. I do believe the 1 minute gave an entry on this one, but I don't really recall this day, so I'm not going to lie to you. That's why I call them phases, right? That's why I call them phases, because it's simply more simple for me to understand, right? That is all. And yeah. Oh, and again, phase two is just from the open to 9:30. There, as an example, I used to like seeing price creating fair value gaps in one direction, and usually that's the direction that the day is going to follow. At first, that's what I thought. And now what I wait for 8:30 to do is we're either trading inside of a phase one fair value gap that has already swapped liquidity. So let's go back to the basics, right? I wait for a run on stops first, then displacement that creates 5 minute fair value gaps, and of course, as the displacement has to also cause a market shift. When all of that happens, that's when I look for the fair value gap to look for a lower time frame entries, right? So if phase two begins and trades inside of that, then that's good for me. I can look in the lower time frames already. I don't have to wait for a run on buy or sell side liquidity to then look for, again, the same thing to repeat. So yeah, through phase two, that's what I want to look at. We either get run on stops and just the complete process from scratch, or maybe phase one already did something that allows us to understand that phase two, all that it has to do is trade inside of one of those fair value gaps that were created after running on buy or sell side liquidity, and that's when we jump into the lower time frames. Or phase two, maybe we don't have a clear trend, as I've done in the past. If I don't have a clear trend, I just wait for phase two to clear that up for me. Maybe it does, maybe it doesn't really matter, honestly. I just wait for that to help me. If it doesn't help me, then there's nothing that I can do, right? I just don't trade, simple as that. So phase 2, 830 to 930, and then what I call phase 3, although I don't really use that concept too much. And let me see what I have written about phase 3. 930 to 11, we'll just be looking for the continuation established through phase 1 and phase 2. Price creates the fair value gaps, price trades inside of those, and then we look for lower time frames. That's simply it. That's literally what we wait for on phase 3. Right? It's just price has already set a trend, and now it's just respecting that. Simple as that. Wanted to talk about displacement because there's a little bit of a confusion on that one, which is understandable, honestly. And again, I'm gonna repeat this once more. Every single concept that I talk about, every single thing, as an example, I say displacement all the time, or fair value gaps, fair value gaps. It's not something that I've taught you because I haven't taught you that because it's something that ICT teaches. I don't explain what a fair value gap is, and I don't think I've ever had, because it's something that is taught already for free on YouTube by someone that explains it much better than I do, and that knows why that's a very important thing to look for. As an example, I do know why fair value gaps are important. It's because price didn't deliver price. Well, the algorithm didn't deliver price efficiently through that, and that's why it tends to when it creates a fair value gap, it just trades back into it to deliver price efficiently, and then when that's created again, it's mitigated again to just continue with the trend. Are there fair value gaps here that don't work out? Yeah, of course. It's not like fair value gaps are the thing that we're just gonna buy or sell when we see one, because we could have had a sell on this one, which would have worked out for a bit, then on this one, that would have not worked out at all, then this one. Why are we not selling those things? Because we don't have the confidence to, right? I mean, personally, I don't trade those because it just doesn't make sense, right? I wait for other things. We need other things to trade inside of a fair value gap. It's not just looking at a fair value gap in the 5 minute and trading it. But I'm getting out of topic. So if you want to understand a concept, you have to watch the mentorship, right? What I'm teaching you here, between quotes, what I'm teaching here is just showing the way that I apply those concepts that are taught by ICT. Simple as that. So displacement. There's a lot of confusion on displacement, and it's understandable because it's difficult to understand. Because as an example, in my opinion, this is displacement. So why is that not worth taking? As an example, this is displacement as well. As you can see, price starts going higher. Then we have this pretty aggressive move that, well, ends up causing a market shift. Look at this candle. Huge candle that causes a pretty aggressive move. I do remember ICT saying displacement is one big beefy candle, right? That's a pretty good way to explain it, right? Price out of nowhere just causes a huge candle that drops or flies up after potentially taking buys or sells of liquidity. Also, if this is displacement higher, well, this is displacement higher. You can see how price just going up. Not much wicks, pretty big candles. Why would we not take advantage of this? Why could we take advantage of this? The thing is that we have to look at displacement as just one thing, because displacement tend to happen after something has happened. Displacement is something that we do want to look for. But displacement, for me personally, it's something that I want to see on the second step per se, right? After price just run on liquidity, that's when I want to see displacement against that. So if we have liquidity here and I see displacement there, that's where I'm going to be interested. If I see liquidity here, price does this, and displays is higher, that's what I'm interested in. If my daily trend is bullish and I see this, that's a really good sign for me to buy, right? So displacement, again, is this. Aggression. Price going aggressively higher, potentially after something has happened. As an example, do we have a run on sell side liquidity here? Yeah, we do. Price goes aggressively higher. Will I look for entries here? Yeah, why not? price has been bullish the entire day. Look at all of the sell side that was taken here. Displacement higher, fair value gap. Does this one fail? Yeah, we might have gotten a lower time frame entry and it fails. Why does it fail? Well, I don't know exactly a reason, and I'm not going to analyze this price action, but as an example, we do have a tiny bit of a high liquidity taken, displacement here, and this works out, right? Then there's even more that is later respected. So could have we taken a sell here, a buy here, and would have very likely taken a loss? Yes. But at the same time, what do we have? High being taken, so buy side liquidity being taken, displacement on the 5-minute as well. So at that point, we are going to be looking for entries on this side as well. Now, in this case, there's no market shift lower on this displacement, right? So as there's no market shift, I can't really do much. But this displacement here causes a market shift, and that's definitely something that I want to be taking advantage of, right? So displacement is aggression. Is when price clearly shows that it wants to get out of where it currently is. Price is going somewhat aggressively up. We do see a lot of wicks, so it's a little bit of an indecision for price to doesn't really know where to go, but it does go a bit slowly. And look at how price then aggressively drops. And displacement also does create fair value gaps. For me personally, when I say that I want to see displacement, I mean that displacement has to have fair value gaps in it. If it doesn't have fair value gaps, it could still be displacement, because price, as an example, could create something like this. A huge candle down, another huge candle down, and the fair value gap will be in here, as an example, in this. But what does the next candle do? It trades a bit lower, and then it completely goes higher, filling up what would have been the fair value gap. So there's no way for me to apply that. So is this displacement? It is. It's just that it didn't create a fair value gap. So I'm not going to use that because I don't have the fair value gap. Fair value gap is what I'm going to need to take an entry 100%. If I don't have a fair value gap, there's literally nothing that I can do. Even if there was a pretty clear random buys or sells of liquidity, even if there's huge displacement, but if a fair value gap doesn't show up in the 5 or the 15, I cannot trade and will not trade. That's as simple as it is. I went back to Friday. Doesn't really matter. So that's displacement. I'm writing down shit. I made a mistake on it, but okay. I can't really say when displacement was finished. Let's talk about bias. I'm gonna explain it the way that I understand it, but this is something that you should watch from ICT. I'm actually let me look at my Notion, because as I've been taking notes again or rewatching the mentorship, I've gone through one class recently. Oh, actually, I have it right here. Class 7 is daily bias and consolidation hurdles. Right? So I'm not gonna explain it because it's again taught here, and you can go back and watch it. But as an example, if we look into this example right here, why would have we expected a bullish direction? If A30 is this, A30 trades a bit higher, then aggressively lower, and then changes direction completely. Of course, keep in mind that this is the 15-minute time frame. So in the 5-minute, we could have had in this aggression here, could have had a fair value gap the price just trades into, and that's our entry, right? That's where we can find entries in the lower time frames. What ICT teaches, and I'm going to paraphrase everything here, and I'm actually going to talk mostly from me. But the way that I remember this, and I haven't gotten there yet, in my opinion. If the market has just taken a big amount of sell-side liquidity, I'd expect the market to take a big amount of buy-side liquidity next. So if price has just taken sell-side liquidity aggressively here, I'd expect it at the very least to maybe take this high, or maybe take this couple of highs that are here, or maybe go all the way up to that one. Which, as an example, in my opinion, when this low was taken as aggressive as it was, this aggression from here could have been used as a target, but then price does all of this. But of course, why does it do all of that? Because this is spread hours, Tokyo, Sydney sessions, and then we get into the timing where we actually do get move, which is London, New York, and PM session, right? So how do I determine my bias? I've talked about it a couple of times, but as an example, if I get up to this, or if I am analyzing price at 8:30 and I see this to my left, how can I determine the bias? Bias is something that we're never going to have 100% right? We can not know that price will continue going higher after a certain amount of time. You could just say, okay, so I'm turning back down or lower or higher here, and it just stops. For me, as I just explained, I understand that if sell side is taken, buy side is taken next. Of course, that could be interpreted or interpreted, however it's said, like the market then if... Okay, let me start it over. If I'm saying that if sell side is taken first, then next thing that is going to happen is buy side is going to be taken, that could be interpreted as this. The market moves like this. Why would it move like this? Because sell side, buy side, sell side, buy side, sell side, buy side. Now, does the market, what would happen next? Of course, just buy side, to then sell side, to then buy side. Does the market move like this? No, it doesn't. And then you could say, okay, so then the market doesn't work like that. It does work like that. It does go to sell side, then buy side, but sometimes it's something like this. Price is going lower, right? Going lower, lower, lower. There was sell side taken there. Let's ignore it, right? Then something like this happens. More sell side. And then what do we have above here? Buy side. What do we have above here? Buy side. So price, what do we have here? Displacement, just about taken. So we can trade this. Takes buy side. Liquidity, liquidity. Displacement, market shift. Liquidity for later. Liquidity for later, and at the same time we have this. So example, price is reacting to previous lows. So now price could say, okay, so I took sell side, a lot of it. Let's take buy side, and then let's just continue lower. That's how the market works. So now it's difficult. It's difficult. I understand it, because till this point I can't say for sure the day has started by taking sell side. So I'm gonna expect price to go to the buy side. But what buy side? How do we know when will price stop? And that's something that we can't know. At least as far as I know, I don't think we can know for sure. But thing is that if I get up or start analyzing the charts to this, sell side liquidity was just taken. If we look to the left, as you know, this week was somewhat bullish. Was price just doing something like this? So we are here. Could I expect price to go higher once more? Yeah, definitely. Why? Because sell side was taken down here, or maybe something like this happened. So in this example, oh, it doesn't matter. In this example, I get up or I start analyzing the chart. Price took sell side and then starts going aggressively higher. What happened through phase one? Moved against the trend, took sell side and displaced higher. We have a market shift here, fair value gap, and now a fair value gap that is created through this price action that we have here. How do I determine bias? By this. What is price doing? Is it taking sell side? Is it taking buy side? Which side is it moving to? It's as simple as that. Let's go for another day, because this one was a bit complicated. This one, and of course I've explained this price action already with the week resume, but I'm trying to explain bias. Why would I expect the day to be bearish if I'm right here? If I'm here, I wake up to this, right? Or I get into a charts to this, and this price action took a lot of buy side liquidity. We have a daily fair value gap being mitigated on this price action, and then price market shift, fair value gap respected, continuation of the trend, more fair value gaps respected, tiny run on liquidity, continuation of the trend, buy side, sell side liquidity taken, buy side liquidity, continuation of the trend, displacement, more and more interest. Why would I not expect price to go lower? Now, when does the bias change in this day? When price starts doing weird stuff. Why is price ranging? Price is ranging because of something. Price never ranges because of nothing, right? It's not going to range to just range. It's not going to impulse just because it wants to impulse. Price does everything because it has a reason to do that. Now, when it ranges, I like to look at the left and what could happen next. Ranges, as explained by ICT, a range or a consolidation is never going to cause a reversal nor a retracement, right? To then continue lower. Ranges cause continuation, right? So range has to continue. It doesn't matter if it continues 10 million pips or if it just continues 7 pips, but here it has taken sell side, so it could do something like this to continue lower, right? So for me, bias is as simple as saying if price is going lower by taking buy side liquidity and looking for sell side liquidity, I'm going to trade in that direction. What do I wait for in price before taking an entry? For price to take sell side or buy side liquidity, change directions, create fair value gap, that's my entry. What am I going to target? There are a couple of equal highs here. There are a couple of equal highs on this. Can I go for the 50% of the retracement? So 50% of the move of the retracement? I can definitely go for that, right? Can I be aggressive and say, okay, so we've taken all of this sell side, we're going to go up to that high? Yeah, I wouldn't do that, but yeah, we can. So bias is complicated, but every single day I get into the charts, and this is exactly what I do. I get into the charts at this point. Price, at the same time, it's just looking at the trend. What if you're looking into this chart, what are you seeing? Price just going lower. Then you jump onto more details. What has price actually done? There's a high here, taken as liquidity, couple of highs taken as liquidity. Price continued lower, took sell side, created a bit of buy side, goes higher, another buy side here, taken, continues lower, more liquidity in here, displacement, continuation of the trend aggressively, a lot of sell side, so it could look into retracing. But what's the thing? If I'm seeing price being bearish, I'm gonna look for bearish continuations. So if I see this, let's actually do it like this. If I see this price action, could I expect a bullish day? Let's say yes. Let's say yes because the week was bullish. Let's suppose we were expecting a bullish day. Can we expect a bullish day? We definitely can. What has just happened though? We see a lot of sell side, a lot of buy side being taken, and we have some sell side being taken. What do we want to see now? Displacement with the 5 minute that creates a fair value gap and a market shift, and that's what we can buy out to this. What do we hit? What do we get? That's displacement. That's something that we can try and take advantage of. If we wanted to buy from there, we definitely do have a market shift. Let's suppose we bought there. Okay. Want to target all the way up here? Sure. Of course, there's a 1 to a 7, so 1 to a 1 to 7, so I would have definitely not taken that. Okay, we're here, right? Let's suppose we're still in this buy, hoping for this, not hoping, but understanding that that high could be taken. What happens later? Tiny run above this high, still respecting previous flow. And this is important because if we're inside of this trade, what is happening right now? First of all, it's taking a lot of time to break that high. We have buy side, buy side being taken and then goes lower. There's buy side liquidity above this high, taken, goes lower, displaces, causes a market shift, and creates a potential scenario like this. If I'm inside of a buy that is working out the way that it is, taking a lot of time to get to target, it starts taking liquidity against me, right? Without creating much. As an example, could we say that we had sell side on this? I explained on the week resume. Yeah. Do we have displacement higher to maybe even look for a scaling opportunity? We don't. That's when you also start seeing that difference of what price intent is. You're seeing sell side being taken. Sell side was taken here, creates that entry. Great, you're inside of that entry. But then more sell side is taken, and at no point you see displacement to actually try and take advantage of that. But what does happen? Buy side is taken, creates fair value gaps. Which side is currently working for the best? There was buy side taken here, starts going lower. Does it displace? No, not really. Comes back up, creates more and more liquidity, displaces after taking buy side liquidity. Bias is about adapting on what you get, and at the same time understand, of course, the concepts and why could price go higher or lower depending on what you're getting. So if we go further into the day, if I get up onto or I get into a charge to this, what has happened through the entire night? Taken, continuation of the trend. Of course, this does take sell side, which is why price took this high, created these highs and took them, and then continued with the trend. More sell side was taken, retraces, creates more buy side. Taken, continues with the trend. Why would I not expect the bearish day if price first of all has been bearish and now it has just created buy side liquidity and caused displacement with a market shift to try and sell? That's the way that I decide or that I determine my bias. Of course, what extra do I have? I am expecting a bearish week. Maybe we've taken a lot of liquidity from the 1 hour. Maybe we've mitigated something in the 1 hour. There are things that we can start adding up in our favor and stuff like that. So I could have been a sell, right? I could have taken. What are we aiming? We have this low that is, if we're right about the trend, this is the low that should be taken, right? Just creating that lower low. If we look to the left, what is that we have? Well, that low is somewhat reacting to around these same levels, right? So could we use this previous low as liquidity to try and target? Yeah, we could. Bit complicated in certain way. And I need to drink some water. Complicated, but possible overall, right? Because it's just the way that the market works. It's not going to make it easy for us. Even if we understand that price is going to take sell side next, we're never going to 100% know that this was the next sell side to be taken. Could have been much lower, could have been maybe already taken, or just this tiny bit of a low, and then it would have continued higher, right? Let me drink water. So I'm trying to explain bias the best that I can because it's a complicated concept, and to a point I still have issues trying to understand it, right? I don't get the bias right every single time. And even Tuesday was the clearest day in my opinion this week, because the bias was just there. The bias was just there. So, as an example, let's look at it from the 15. Look at the buy side created here, right? We wake up around here or get into a chart around there, and look at this. This just buy side being there, just waiting to be taken. Tons of stop losses, and then we had, of course, this is range, this consolidation. Buy side was respected, but sell side wasn't. And then we see this. Sure, was it caused by the news? Yeah. Does it really matter? Because no, because it created what we were expecting anyways. As I've mentioned in the past, news are either something that ruin price action, but then just come back to where they were, right? So as an example, let's suppose price is something like this, and then we get news, and then gets back up to where it was. News either do that and ruin price action in the meantime, or they just speed up what price was supposed to do anyways. That's why, as an example, in the past with previous strategies that I used, I wasn't really scared of the news, because if I was right about my my analysis, price could go in my favor with news. It's not worth it keeping interest in news, because if you're wrong, you're leaving out of all of the profits on the table, and it's not worth it. But that's what I used in the past, and it worked out quite well for me. So having this, sell side was taken, buy side is being respected. Why not take it? Again, let's suppose we didn't realize of this, because I didn't this day. If we go into the lower time frames, what is it that we have? Even if we want to use the phase 1, phase 2 thing, phase 1 ranges, goes against the trend, trades inside of a rally gap, takes sell side liquidity. Phase 2 already begins inside of a, well, not a phase 1 for rally gap, to be fully honest. Does trade into it, doesn't give interest in the lower time frames. Phase 1, this fair value gap basically fails. And then we have fair value gaps reading credit in this direction. How could we determine, without really even looking at the left, how could we determine that this case they could have been bullish? Sell side aggression, fair value gap. Sell side aggression, taken as liquidity. Sell side aggression, fair value gap. Sell side aggression, fair value gap. Just looking into that, into the runs on liquidity and the aggression price will just tell you. Simple as that. The complicated thing is that in some cases we just don't realize. So, example, I didn't realize that this day was going to be bullish. I didn't realize such a clear confluence in this, and it is what it is. But at the same time, price was so clear with the price action inside of the kill zone pre-New York and London that it was just there. It's just there waiting to happen. And then that happened, which is sure, this is, as an example, this is something that we cannot predict. We can understand that price has an opportunity to go higher based on the buy side liquidity, the sell side, and everything, but we're never going to know if the move is going to be like this or if the move is going to be like this. It's kind of retrace, move, but causes multiple retracements, and then maybe it does get to the same point. But it took much more time, right? That's my bias thing. Again, watch class 7 on ICT. He does talk about daily bias and hurdles, about consolidations, I think. But overall, just watch the entire mentorship, because if you don't watch the entire mentorship, you're just not going to understand what I'm trying to teach you here, what I'm trying to explain here. Okay, so we got this, we got that. I want to talk about patience now, which I already talked about, in my opinion, pretty well yesterday. Patience, something that is complicated, but it is overall simple. It's what ruins patience is fear of missing out. It's, as an example, you start a Monday, and as an example, this is the reason why I stopped using Instagram. And if you check my Instagram right now, I don't follow anyone but FTMO, and I should follow MFF because I also do use accounts with them. But if you are on Instagram, as an example, you might, if you get up to trade New York, you're going to see that someone through London, if you follow multiple traders, you're going to see that someone through London took a buy. As an example, let's suppose they took this buy. Somehow, based on whatever analysis they made, they had an entry like this, and they took, let's do something a bit more realistic, 7R, taking maybe 15 minutes. You get into a charts, you see that, and you say, wow, this trader managed to get a pretty good trade through London, so I kind of missed out on that one. That's a shame, isn't it? Then you get into session starts a bit blurry, right? Doesn't really move much. Tiny move to the downside. Maybe this is the sell. I don't want to miss out on the next move. Let's just take it. And then you take a loss. And then this happens. You wanted to take an entry. You wanted to force an entry because you thought that this was this move. When you had confluences to sell, but you didn't get all of them. Remember that we had a 5-minute fair value gap to sell from there, but I wait for the lower time frame, so there was no entry for me there. Do we get a buy there? We do. But as an example, fear of missing out is the worst thing about trading. Fear of missing out is literally what complicates the entire thing. Because patience, it's easy to have, but fearing of missing out on the next big move, not a big move of 1,000 pips, I'm not saying that, this big move, like some move like this. As an example, let's suppose this was the entire move. That's a pretty big move in the 1 minute, right? If we go to the 1 minute, that's a pretty big move, isn't it? Right? This maybe 4 or 5R, it's pretty good. We can get more than that, definitely, but that's a pretty big move that you might not take. And the fear of missing out on that makes you impatient. It says, okay, so this sell looks good on the 5-minute, price is ranging, it's likely to go lower. No, it's not. You don't have the confluences to sell from here, so don't. The area failed, price has been bearish overall, why not take this? Because the buy side is doing its thing. And this failed. It doesn't matter that it failed by a tick, by 2 ticks, by a pip, by... I don't care how much it fails by. If it fails, it fails. That structure is useless. So I'm rambling a bit more than I wanted to ramble about this. But here's the thing. I'm gonna use my example. I get into the charts lately around 8:20 because I've started exercising as soon as I get up. So from 6:30 New York up to 8, yeah, I'm exercising. Then I take a shower and then I make my breakfast. So I'm getting onto the charts around 8:20, 8:25, and of course, as soon as I get up, I have 2 monitors. So on one I have the workout that I have to do, and on the other one I have my charts. And of course, even though I do start analyzing more thoroughly at 8:20, 8:25, 8:30, I do kind of know what happened and what I could expect through the session. So I'm just going to say that I get onto a charts at 8:30. 8:30 is already a point where I can begin trading. I trade from 8:30 up to 10 or 9:30, right? After 10, it depends a lot on what happened through the day. Because if the entire session was probably doing this, if it's 9:30, I'm already quitting. I'm not watching the rest of price action because it's either going to do this or it's going to take buy side, take sell side, and then just range. Or do something like that. Do something stupid that I don't really want to lose my time on. Or I could end up forcing an opportunity that I don't want to do. Because I make mistakes and I do force opportunities every now and then. So I personally get onto the charts and I know that I have to wait for, first, a run and stops, second, a displacement and market shift on the 5 or 15 minute, and after that I go into the lower time frames and wait for price to get to a fair value gap that was created either on the 5 or the 15 right after the run and stops happened. Let me ask you the next. What should I do if that doesn't happen? Let's suppose price is just going bullish, right? Going higher, blah, blah, blah. Session begins here. That's when I start analyzing, trace a bit against the trend. Doesn't take buy side, sorry, sell side. Continues going higher. Multiple fair value gaps, blah, blah, blah. Tiny run on, let's suppose we have a tiny run liquidity. Not displacement here. Continues higher. Doesn't even trade inside whatever displacement we could have had. Continues higher, and this is 9:30. Let's just call that 10. Should have I taken any kind of trade in this? No. Do we have the run and stops, which is the first thing that I have to wait for? Yeah. Do we get a displacement, the 5 or the 15? No. Does it even trade, if we had a displacement, does it even trade inside the fair value gap? It doesn't. So what is this day to me? A day where I just didn't have opportunities to take. And we are going to have days like that. Let's suppose the next. I'm having a day like this, and I say, let's just wait a bit more to see if anything happens. And then something like this shows up. Run and stops, market shift, fair value gap. Trace into it, the entry in the lower time frame looks fine, not really good. And then starts working in my favor. Maybe I took this sell, and then that happens. Was that it? Did that have anything to do with my strategy? I mean, maybe, because yeah, sure, we do have the run stops, displacement, and the lower time frame entry, although it wasn't the best entry. Should have I been trading after 10, after a day where I didn't have any many opportunities? No, probably not. Could have I? Yeah, sure, let's suppose that. But look at what we're basing this entry on. This is what I would consider forcing an opportunity. Because we just have one tiny high that is taken, then you have a market shift. And fair value gap in the 5 minute, then you can try and take advantage of. After such a bullish day, taking just that as enough to, as an example, sell, or taking that just as, just as an example, to try and take a selling opportunity, is not enough. It'd be saying we do have the necessary, but we're forcing an opportunity on this. it's pretty, let's suppose this time it's already around 11, so we should, or pretty close to 11, so we shouldn't be really trading anymore. And the entire day has been bullish without price retracing much, without price doing much. It's better to just say, fuck that, let's just avoid this opportunity and wait for the next day. Because you're taking this loss and then you feel stupid. You feel like we literally were the entire day bullish. We have the tiniest confluence to sell. I mean, everything does happen the way that we should expect it, but we're definitely going against the trend on this one. So why risk it after a day where I just avoided losses and just didn't take opportunities? Why not just leave the day for tomorrow? If tomorrow is Saturday and you want to force an opportunity because it's Friday, just go for it, right? Go for it. If you take a loss, you take a loss. If you take a win, you take a win, but you're going to learn from it, which is what we need to do. So, personally, lately, I've been avoiding this. Friday, if you saw the resume, I did force an opportunity like this. So, well, I was pretty happy, worked out in my favor, but I'm not happy that I took that trade. Because looking back at it, this is the exact example. It just basically had the tiniest confluence in our favor, which is everything that we look for, but the tiniest confluence. So taking something like that is just useless. It's forcing an opportunity at the end of the day, just trying to take something and trying to take advantage of a tiny potential move that could occur. So it's, for me, patience in trading is complicated because I want to trade. Everyone wants to trade. Everyone wants to try and take an opportunity that could give you profits. But it's really not worth taking everything that you see or taking everything with as little confluence as possible. So, patience is having a plan or having things that you know work out, wait for them, and if they don't show up, then you just don't take it. You just not take them. It's as simple as that, right? It can be complicated sometimes, again, because of FOMO, right? Fear of missing out. But overall, it is what it is. Okay, so we're going to talk about risk management now. And it's a little bit of a complicated subject because it's not something that I want to explain in depth a lot. But it's something that every single trader should know about. And yeah, I just wanted to talk about it a little bit because, well, since we're on it. I'm not going to talk about how much you should risk. I'm not going to talk about how much you should risk. Percentage wise, I believe that 1% is more than enough. If you want to go higher than that, go higher than that. That's on you. I wouldn't recommend it. I would recommend going for 0.5 or 0.25, whatever it is that makes you feel comfortable. Go for that, right? 1% for me is comfortable. And also will depend on multiple factors I will talk about now. Because risk to reward ratio is something that is, risk management is something that depends on multiple factors. It's not just, how much risk, right? So let's do it like this. Hopefully I can get my point across. With this, the straight line is profit. This decline line is a loss. So how do I do it like this? You get the point. What do we have here? We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 opportunities, or 13 trades, of which 1, 2, 3, 4, 5, 6 were profitable, and well, 5. No, 5. 7 were losses. So 7L, 6 wins. A 1 to a 2 makes you finish 1 R down. Minus 1 R. A 1 to a 3, and I have to use a multiplier here. Actually, not. 16 by 3 is 18, or multiply by 3 is 18, minus 7 is plus 11R. Let me check if the math is right on that one. Yeah. So look at the difference between 1 to a 2 and 1 to a 3. It's just adding an extra R that gives you literally 12 R. This is why risk to reward ratio is really important, first of all. And also, we need win rate, right? So win rate percentage. Let me actually do that R a bit better. I don't have a really good win rate. Based on my back testing, is around between 45 and 55. It doesn't get higher than that. Honestly, in back testing, I tend to be a bit freer or more free when I take opportunities. So I'm not as rigid or strict about what I take compared to, as an example, challenge and funded accounts. But let's just say a 50%. A 50% with a 1 to a 3, it's going to give you a lot of win rate, right? If we said that we had 12 opportunities, 6 wins, 6 losses, at a 1 to a 2, 1 to a 2, 1 to a 1, of course, is going to be way less profitable. Wait, 6 by 12? No, I made the math wrong here. Yeah, okay. I'm not good at math, okay? So 6 is 12 minus 12 is plus 5R. Does it allow you to be high? Yeah, definitely. 5R is really good, right? But 10 trades, based on what I've traded, 10 trades might be a week and a half, maybe 2 weeks, right? So 5R up in 2 weeks, not really ideal, but profitable. So if you feel comfortable with that, go for that, right? I don't feel comfortable with that because it takes a lot of time to be 2 weeks trading and to actually get 13 opportunities, right? But again, depends on you. So 12 trades, 6 wins, 6 losses, a 1 to a 2 gives you 12 minus 6, an extra 6R. 1 to a 3 is going to give you 12R. 1 to a 4 is going to give you what? So 6 multiplied by 4 is 24 minus 6 is 18R. And I think we're just going to keep on adding 6, 12, so 24R in a 1 to a 5. I use 1 to a 4 or 1 to a 5. Usually go for 1 to a 5, as you've seen as an example on the trade that I took the other day on the recording. That's what I do like to go for, the very bare minimum. But in some cases we get lower than that. Now, of course, let's suppose, or higher than that. Let's suppose we had 15 opportunities. Sorry, 12 opportunities with higher risk to reward ratio. Let's say you have a 70% chance of winning, right? That'll be, let's call it 8 against 4. Already a 1 to a 2. A 1 to a 2 gives you 8 by 2. Am I doing the math right on this one? I'm so scared that I'm not doing the math right on this one. So this is 16R minus 4 losses, that's 12R. If we had a 1 to a 3, this is not right. If we had a 1 to a 3, how much is that? 24 minus 4, 20R. And I'm guessing that it's just adding 6 again, so 26R. You know, 1 to a 4. 1 to a 4, in my opinion, is pretty good spot, right? Either if you have 50 or 40% win rate, 1 to a 4, in my opinion, is really good, right? Because even if we had 12 and you had 4 wins and 8 losses, in a 1 to a 2, you are in break even. In a 1 to a 3, you already are in profit by 6. 4 by 3 is 12, minus 8 is 4. I'm so scared that I'm doing the math wrong here, so just take this with a little bit of salt. So 4, 16, minus 8 is 8, and so on and so forth. So what I'm trying to show here is that you need a somewhat good risk to reward rate, somewhat good win rate, and a somewhat good risk to reward ratio. Combined, that's how people make money with Forex. This is how people can be profitable in Forex. Because if you risked 100% of your account on each trade, you're gonna lose your money. If you risk a 70% of your account on each trade, you're gonna lose money. You're gonna lose because no one is able to have a 80% win rate consistently. You're never going to have, out of 10 trades, you're gonna lose 2, and those 2 might come together. So if you risk 70% of your account, you were making a lot of money, but you're risking 70% of your account. So in those 2 trades, if they happened together, you lost your money. You lost your account, basically. So that's why, as an example, 1% risk allows you to do anything you want. You have a good risk-to-reward ratio. It's going to reward you pretty well. You get a good win-to-reward ratio. Win ratio. You're going to be even better, right? So as an example, if you have a high win ratio, you might not need a pretty high risk-to-reward ratio. So you might be happy with a 1-to-3 instead of a 1-to-4. But if you have both of these high, you're going to be pretty high up with risk with R's, right? You're going to be maybe, instead of 20 on this one, maybe, I don't know, 30, 40, who knows, right? Risk to reward ratio is something needed. Now, right? Now I just want to do this little bit of an introduction. That's why you need a good win ratio. And that's why you need a good risk to reward ratio. If you don't have both of those at a pretty balanced scale, it's just really complicated. It's just really complicated to have a profitable business, to call it somehow, by having a low win ratio and a low risk reward ratio. If both of these are high, you're fine. If this is low but this is high, you're fine. If this is high and this is low, you're fine probably, right? Unless you're going for the 1-to-1, which is not ideal, but if this is high, supposedly it should work out well. Now, after that, let's talk about, also, how can you make this be better? How can you improve that? By backtesting, by experience, by understanding how the market works, or how your strategy better set works, and how you can look for better opportunities to take. Because as an example, I could say that what I want is run on stops, displacement, fair value gap, market shift in 5 minutes. Or maybe I could say, let's go 5 minutes. And 3, lower time frame entry. Now, what is lower time frame entry? As an example, on the lower time frame entry, I could say that I want the exact same thing. I want to see a run on stops, displacement, fair value gap with market shift on the 1 minute, of course. As an example, right? This will allow me to have a somewhat good risk to reward ratio because I'm waiting for multiple confluences to be buying or selling, right? I'm waiting for multiple confluences that allow me to believe price could go higher or lower. Now, what happens if by lower time frame entry, I just want price to create a fair value gap? That could lead me to have a lower percentage of, I don't want to say efficiency, of precision, because I'm going for a very weak lower time frame confluence. Because a fair value gap is very likely going to be created, even if the trade is not going to work out. Now, if you add things to this, you're going to have less opportunities. You're going to filter out some bad ones. You're going to filter out some good ones at the same time. Because I've had, as an example, yesterday, well, on the week resume, you were able to see that I think it was on Thursday or Wednesday, I don't remember. We had clear run and sell liquidity, clear 5-minute displacement, but there was no market shift. And that made me miss out on an opportunity that would have made me make around 5 to 6%, if I remember correctly. Am I worried about that? No. Am I going to change my strategy because of that? No. That's how you personally can improve your risk reward, your win rate, better said. And yeah, that's pretty much it for risk management. And now I'm going to talk about a couple of tips that I have for everyone, right? For everyone that is thinking about taking this more seriously. And what I don't want to use the typical cliche of what I would have liked to know when I was younger or anything like that, but it's pretty much what I'm gonna be doing or talking about here. It's just a couple of tips again that I do believe they're worth. Okay, so my tips, right? I've lost multiple. Let's call it multiple because if I'm gonna be honest, I have no idea how many challenges I've lost. But I've lost multiple of them, of which, as an example, currently I would love to have the money of those challenges that I just pretty much wasted completely, right? Because as an example, I took a challenge a couple of years ago already, or a year ago. I think it was just a year ago. I think most of the challenges that I took were last year. It's 2021. I took multiple challenges, of which the first failed completely, and the reason were two. First of all, I had just joined Phantom Trading. I think I had a month learning with them, and after that month, I was 2 weeks was pretty lucky in my opinion because I don't really remember how much I actually got, but I got like some pretty good trades with a high risk to reward ratio. Talking about maybe 2 or 3 trades where I got 10, 20 R on each one because Phantom Trading does have that. That's have long term, not long term, short term high risk to reward ratio. And basically just said I'm ready for this. Jumped into funded onto a challenge, didn't pass it, managed by I don't know, a miracle to get back up to break even, to get a retry, and I think I got like 3 or 4 retries before I actually got funded. Luckily, and first month just completely blew it by maybe not 2 3 trades, maybe 2 weeks or something like that. That was with funding talent, so even if I had made money, I probably would have not even gotten paid. So I think it was easier for me to lose the account like that than to actually make money and not even get paid. God. And after that, changed into my Forex funds, on which I probably bought more than 5 challenges that I also completely lost, and it was one after the other one. It was one after the other one, on which I I was just not ready. It's like before jumping into funding onto MFF, I was like, let's study for a bit and let's make sure that I'm actually making it right. And probably was around the same thing. Like I was a week where I had some really good trades or really good analysis, and I said, okay, I'm ready. Yeah, I'm definitely ready. Jumped into my Forex funds, probably did good for a bit, but then just completely failed. Didn't even manage to get back up to break even and lose the account, and then just buy one immediately after because I felt ready. Then finally, at some point, I did with the strategy that I was teaching a couple of months ago. I did manage to get to pass a challenge, to pass a verification, to get funded, and I made a pretty good month on which I was able to withdraw. Well, I made it 10%. They keep 75 or 80. I don't remember what the first month was, but basically got some pretty good money that I was pretty happy to have, and simply great, right? And after that, I still have that funded, and I also have a challenge that I'm working on at 20k on MFF. And the funded is a bit complicated because I stopped using my strategy and changed into ICT because my strategy used to be high probability, but very few opportunities, and I would take a lot of losses because I would force those opportunities because of fear of missing out. So I had maybe 2-3 trades, if luckily, per week. Usually 1, sometimes 0. And the problem with that was that if I missed out on the opportunity, I might not get another one for the rest of the week. So that was my pretty high fear of missing out issue that I have with that strategy, in that it was just making me make a lot of mistakes. But again, impatience and just not really refining it down. Strategy that still works, because I've been backtesting it a couple of weeks ago, just trying to see if I still remember how it worked, and it actually does work out and everything every now and then. But then it's changed to ICT. That's when I stopped trading unfunded, and I left it at a little bit of a drawdown, which I can still recover, because MFF does just if you have a funded that you haven't drawdown, then you just have to get it back up. Otherwise, there's nothing that you can do. And basically, the reason why I'm telling you all this is so you understand why I'm going to tell you what I'm about to tell you. If you are thinking about jumping on a funded account, or not a funded account, a challenge, either MFF, FTMO, the prop firm, I don't remember the other ones, honestly, I don't really care about the other ones. Think about it, right? As an example, for me personally, it's hard for me to get the amount of dollars that you need to get a funded account. In the past, because I didn't work. Now, because the economy in my country is pretty shitty, and it's more difficult to get dollars or to buy something in dollars. And I currently do not work. I do have some money saved. I do have some money from funded. But overall, I don't really have much access to money. Maybe you work, maybe you have a lot of savings, or maybe you live in a country where getting the amount of dollars, as an example for an MFF, is not really that much. So maybe you think it's not that much money, let's give it a try. And honestly, the problem with that mentality is that, from what I just told you, you should realize that it's better to not get into a funded, continue to improve without having to worry about a funded account or a challenge account. And whenever you actually do trade well, that's when you jump into a challenge and you pass it right away. That's the best thing that I can give you a tip, right? That I can just tell you, it's better if you do that. I'm not giving financial advice on this. You already know that. But if you're thinking about jumping into a prop firm, think about it, right? Think about it. Because again, I would have preferred spent my 2021 studying and actually learning and perfecting a strategy where I can sit down for 4, 6, 7, 8 weeks in a row, getting profitable well, right? As we just talked with the risk management, right? If I got 20R, or at least maybe 12, 18R at the end of the day, at the end of the month, then I'm happy with that. If I'm just getting by with 6R, 5R after a month or two, that's not consistent. Sure, it is consistent, don't get me wrong. The very minimum that you can do is be consistent as low as you can. Then you start refining it down to better consistency with 10R, 15R, maybe even more, right? Because it's better to get 5R each month than to get none of them or lose Rs, right? But what I'm trying to say here is that you have to be consistent and know that you're going to be able to make enough profits to pass a challenge. 5R, unless you're risking a lot, 5R is not going to make you pass any kind of challenges. But yeah, that's really pretty much it. I mean, because when you're learning, if you jump onto a challenge account, you're likely going to be more worried about passing it, making you feel even more impatient than usual, and making you make more mistakes. Instead, spend those couple of months that you could have spent inside of a funded account struggling to pass it or to get it back up to break even, instead of focusing on what's actually important, which is learning to trade. So learn to trade, learn a strategy, learn a concept, backtest, trade it live. So live, I mean in a live market, not in a live account. Trade it live on a weekly basis. And if you're profitable at the end of a month or 2 months, if you're feeling comfortable with that, go for it. Right? Go for it. But just don't waste money nor time on funded or challenge accounts when you're just not ready. Okay, that's the best advice that I can give you. Best tip, sorry, not advice, not financial advice, tip that I can give you, because it's going to save you from a lot of stress that you shouldn't really be worried about at the time. So this video was much longer than I expected. I kind of wanted to make it short because yesterday's was pretty large, but I do think that I talked about many things that are worth. It's also going to be sectioned anyways, so probably should be fine. But that is pretty much it, honestly. I thank you very much for everything. Got 1,000 something subscribers, actually 1,200 I think, so that's great. Very happy that it's working for you, that it's helping you every single video that I upload. I honestly do like doing this because it does help me as well. When I teach you or when I explain stuff, I realize why certain things work out the way that they do, and also helps me remember the things that I should be looking for and the things that I should be avoiding, which is in some cases difficult to remember or difficult to apply. And when I make these videos, it's a fresh daily reminder of how the market works, how you can make money on it, and that is like how you can actually lose money in it as well. I guess that's important to know as well. So yeah, again, thank you for seeing it. Thank you for being here. Thank you for the commentaries. I do appreciate the feedback. And again, any questions that you have, please leave them in the comments. Because as an example, on weekends I do like making videos, and if I don't really have much to make a video on, then it's like I kind of do want to make a video for you all and try to help, but I just don't really have any kind of subject to do that. Something that I might try this week is record the session, which I don't like doing because I don't really spend much time in front of the charts. But what I wanted to do is try to explain my thought process through it. Why am I expecting this to happen? Why am I expecting that to happen? Why do I want to look for opportunities here or not want to look for opportunities here? Which could help a lot, because I do see that many of you are worried, not worried, but having complications with that, with the bias, the daily trading, like how to spectate the market, how to watch price delivery. And it's something complicated, but honestly, it just shouldn't be. It just shouldn't be. So I will definitely try and record, and if anything good shows up, then I'll be sharing it. But I don't want to make any promises. So that's all. That's all from me. Thank you for watching. Hope this was helpful, and I'll be seeing you until the next one.